All right, YouTube. Today we're going to go over the difference between inflation and debasement. And it's a very important concept to understand. It's one that I wish I knew when I was just starting my investment journey. Inflation, pretty much everybody's heard that word before. It's representative of prices going up. So if you ever heard of CPI inflation before, oh, come on, there's a little piece of hair that just won't stick down. I hate that. CPI inflation is representative of a basket of consumer goods, consumer price inflation, and it consists of stuff like food, transportation, gas prices, education prices, rent, alcohol, essentially just a lot of things that you would use in your day-to-day life. And CPI is meant to track the price changes on a year-to-year basis of what those prices would look like. Essentially, that just means inflation is prices going up or down, which is very, very different to debasement. Debasement specifically talks about the dilution of the money supply at a central level, how much money there is in circulation. And believe it or not, they are completely different. Inflation generally, they have tried to keep it at around 2% a year up until the pandemic, and then they essentially shot it up as about 9%. There's a lot of money printing going on, paying for people to stay at home. Prices shot up, not a lot of people being productive. And essentially, yeah, stuff has gotten a lot more expensive, and they haven't really exactly managed to get it back down to 2% quite yet. If they ever will, who knows? I personally think that they're going to have a tough time doing it. I think that they're probably going to settle around 3%, which is tough. But debasement is a lot more insidious than inflation. Debasement on a monetary level happens at around 7% a year, which means that they're printing 7% more money every year, and prices are generally going up 2 to 3, 4% in recent times. Now, you might be wondering what that difference is. Well, to give you an example, my favorite example to underscore the difference between inflation and debasement is a can of Coke. So back in the 1950s, you go to your convenience store, can of Coke would be 5 cents, if that. We'll say 1 cent, honestly. Can of Coke is 1 cent. Not that expensive compared to today's money, but that's just because the money's been debased. But nowadays, you go to buy a can of Coke, and you'd be lucky to get that same can of Coke for $1. But for the purposes of the video, we'll go ahead and say that today that same can of Coke that was a cent in the 50s is $1 now. So you would think that the money itself has lost 99% of its purchasing power, right? But essentially, no. The can of Coke is now 100 times what it was before, but that's representative of inflation. Debasement is far worse. So the way that I like to describe it is that can of Coke that was made in the 50s versus today. Do you think that Coca-Cola has maintained the exact same productivity when it comes to making Coke? Or do you think in the last 75 years that Coke has gotten better at making their product, packaging their product, distributing their product to a wider audience, making sure that the sales have gone up to a global audience? Chances are that they have not remained stagnant in that productivity department, and they've actually gotten better and cheaper and faster at producing each can of Coke. Which means that realistically, in a world where your inflation of your can of Coke has gone up 100 times, debasement is more like 2 to 300 times. Meaning that there's 2 to 300 times more currency units, but the can of Coke has only gone up 100 times. And the difference there is called debasement. And the difference between inflation and debasement can basically be summed up as the difference in human productivity. Human productivity has been going up over the last 75 years. As much as the working class people don't really get to see that, this system of inflation and debasement is exactly the reason why. It only makes sense that as humans get better at distributing product and creating product, that the prices of products would go down. If there's a fixed supply currency that we're all using, and people are getting better at it, which means that there's more available per person, it means that in theory, the price should go down because it's easily accessible. We're getting better at producing it. It should be cheaper for the average person to acquire it. But that's not the case. right? And not only is this essentially the upper echelons of society pocketing productivity for themselves, but it's also a way for you to not get the benefits of that and essentially maintain the same quality of life, even though we're getting better as a species at giving that quality of life to people. Um, it's the reason why a lot of things, but ultimately, yeah, in a world where we use sound money, the prices of things should be going down. But they don't, they go up. And that's because inflation is meant to cause you to want to spend your money into the economy rather than hoard it so that there's more economic activity. But ultimately, as we get better as a society at producing things, there's downward pressure on prices, meaning that things will get cheaper over time. In a world where we use sound money, it's better for you to wait to buy something until we get better at producing it than for you to just go out and buy it now. Which means that in order to counteract human productivity, making things cheaper, debasement has to be a lot higher than human productivity to allow inflation to happen. Meaning that prices going up is really the biggest lie we've been ever told. Things are getting easier and easier to produce by the day. But it's the debasement, like I said, 7% debasement, around 3% monetary, or not monetary inflation. Debasement is monetary inflation. Consumer price inflation is going up 2 to 3%, and that's generous, while debasement is at 7%. That difference of 5 to 4% is pocketed by the wealthy class. Now, how do they do it? Well, in my personal opinion, this is not financial advice, I'm not a financial advisor, the S&P 500 on average has gone up around 7.8% in its inception. A lot more in recent years since the pandemic, and especially since 2008, we've seen one of the greatest bull runs in history. Now, the average person obviously doesn't see that because it's held specifically in the stock market, but you take a 7.8% average increase in prices. Well, I'd say 7% of that is actually just monetary debasement, and 0.8% of that is actually companies getting, real growth as far as growing past the sound. So I like to say 7%. If you're above that 7%, you're growing even in a world where we're using sound money and there's no such thing as monetary debasement. In a world where prices are going down, the price of your company is actually going up. And that's kudos to you. That's because you're actually providing value. But 0.8% growth, that sort of paints a picture on how well the economy is actually doing behind the smoke and mirrors of currency manipulation. Like I said, this is all my advice. My opinion, sorry, not financial advice. Absolutely not a financial advisor. But essentially, companies aren't really providing a whole lot of value these days. They just sort of go through the motions of what they've been structured to do. And a lot of these companies are zombie companies, meaning that they have to go into debt to finance their operations. If we used sound money, a lot of these companies wouldn't exist today. And it's only through the fact that they know how to play the debasement versus inflation game, and the fact that the losses in 2008 is an example, when their reach extends what they're able to grasp, it's the average person that ends up bailing out the higher classes of society. But as far as profits are concerned, they're more than happy to pocket that all to themselves as far as stock market gains are concerned. And the way they do it is the inflation versus debasement game that they play. I'd say that the S&P 500 only really sees 0.8% growth a year because a lot of those companies shouldn't exist. As far as the NASDAQ is concerned, the top 100 companies mostly consisting of tech, because tech is the only sector in the United States, apart from hospitality, that actually provides value. And the reason why it's, hyper volatile depending on how much liquidity is in the system, but 15% gain on average in the NASDAQ is representative of about, like I said, you factor in that 7% debasement, you're getting 8% real growth. And it's, quite volatile. You don't see it on average, but if it goes down in any given year, just keep investing and you'll do fine. It'll come back eventually because those companies are always building something. And ultimately, once you view the world through that lens, every single safe investment, such as your bank account or low-end T-bills, end up being a risky asset, because even though you're getting 5% on your treasury bills, you're beating inflation, but you're not quite beating debasement. And that difference between the yield on your treasury and debasement of the currency is how governments are operating these days. It's not that they're bringing in money from tax revenue and able to pay off that debt, or else we would realize that it's stupid to get into debt and we would get out of debt because we will want all of our tax dollars to go to facilitating growth in the economy or whatever the public sector deems is necessary. But it's this game of debasement where treasury bills can maintain 5%, while behind the scenes they're debasing the currency at 7%, and they're able to spend the currency right from the source. So ultimately they're pocketing that 2% difference while you're feeling as though you're making a good investment by barely beating inflation. Once you view inflation and debasement for this lens and you realize that the benchmark isn't inflation but it's actually debasement as far as providing real value in the economy, your perspective begins to flip and you realize that the risky investments are the only investments, and that what quote unquote are safe investments in our traditional finance system are really just meant to skim that purchasing power from you. And it's why, the average person the average person puts money into their bank account while the wealthy people just invest into the stock market. That's where the difference is being pocketed. It might not seem like a lot, but that 4 or 5% when you factor in time and compound interest is a lot. And if you are willing to stomach the volatility over a long period of time, which you are, as if you're in a younger age group, that's where you're going to see your real returns, because you have to be able to beat debasement in order to get real value in the economy. It's why when you start a business and you actually find a way to provide real value, you become rich very, very quickly. Is because all of a sudden, you provide value, you're beating that 7% debasement by default because people just take that money and put it into you as you're providing value. And all you really need to do is find some sort of way to provide value to people for you to start seeing some real gains. And it's why regular people feel like they can't get ahead regardless of what they do or how much they put away, because the vehicles that they're using are basically trying to beat inflation rather than beat debasement. And it's really important to try and beat debasement. It's just the name of the game. That's how the wealthy people are beating us. So unless we're willing to play that same game, we have to figure out a way to do it ourselves. That's pretty much it. I wish I could, make it more complicated for you and tell you the secret sauce to it, but ultimately, you need to get into those quote unquote risky assets and stomach the volatility of them so that over the course of time, you're seeing that 7.8% or more gain in your portfolio. And, sometimes you'll see market crashes. They're inevitable. Sometimes, like I said, people's reach exceeds their grasp, and you'll see a little bit of a dip in the stock market, 20, 30%. And, governments will usually scramble to try and take your money as a taxpayer to plug those holes one way or another. But ultimately, you should just be buying a lot, hand over fist, when those market crashes come, because they tend to recover pretty quickly. Because, like I said, a lot of those companies are just playing the debasement game. And, wise person once said it's one big club and you're not in it. Anyway, guys, I'll leave it at that. Take care, YouTube. Have a good one.